Hello everyone, my name is Craig Adler. I'm a retired certified financial planner. I'm also sometimes known as the Angry Financial Planner. In the beginning of 2025, I made 3 forecasts about investment performance. In this video, we are going to review those results, and I'm also going to share with you my predictions for 2026. But before I go any further, I do want to remind you the forecasts that I have made are to predict annualized returns for the decade ending in 2035, not necessarily to try to forecast each individual year, even though that's what I'll be doing in these summary videos. In the beginning of 2025, I made 3 forecasts. I predicted that US stocks would earn 4%, US bonds would earn 4%, and my third prediction was more generalized, and that was that international equities would outperform their domestic counterparts. Let's go ahead and look at those results. My 4% prediction on US equities was absolutely awful. Last year, US equities earned 18%, over 4 times the anticipated rate of return that I had anticipated. But remember, my forecast was for annualized returns for the decade ending in 2035, not necessarily annual returns each and every individual year. With that being said, my forecast was off significantly for the year of 2025. So why did that happen? The primary reason is individual investors were simply willing to pay more for US equities at the end of the year than they were at the start. And we can see this in something called the Cape 10 Index. At the start of this year, investors were willing to pay $33 for each dollar of corporate earnings. That in itself is a significantly high cost to purchase equities. However, by the end of the year, US investors were willing to pay $40 for each dollar of corporate earnings. The bottom line is the majority of that 18% rate of return came from a speculative component. Individual investors were simply willing to pay more for each dollar of corporate earnings. And if you were to remove that increase in speculative component, the rate of return on US equities was much closer to that 4% that I had forecasted. In terms of my forecast for US bonds, I predicted that they would have an annualized return of 4%. They earned 7%. Not a huge difference, but certainly one that was significant. So why did that happen? It happened because during that year, the yield of the total bond market index fund, which I used as the proxy for bond performance, went down from about 4.5% to just above 4%. That 1/2 of a reduction in the current yield of that fund would add about 2 to 3% in capital appreciation. Well, when you add a 4% yield with a 3% appreciation, that is where that 7% return came from. Yes, it is possible that interest rates continue to go down in 2025, which would continue to move performance higher, but that's not going to go on for the entire decade. At some point, interest rates will normalize, and at some point, they will probably go up again in the future. Interest rates, like everything else, are very cyclical. So my forecast on stocks was awful. My forecast on bonds was close. In terms of my forecast on international securities outperforming US securities, that was spot on. While international securities earned 33%, compared to the 18% annualized return for US equities in 2025. So overall, I felt 2 really good forecasts, US bonds and international stocks doing better than domestic, but terrible results with respect to forecasting US equities. In terms of moving forward for 2026, this is what I would say to you now. The yield on US bond index funds, the total market bond index fund, is still about 4%. Therefore, my forecast for 2026 for US bonds will be 4%. I still believe that US equities are grossly overpriced. And I still believe that for the decade ending in 2035, that the annualized return will be closer to that 4% figure that I shared with you. So once again, for 2026, I'm going to forecast very low equity rates of return, probably somewhere in the area of 2 to 3% at the most. And like last year, I'm also going to predict that international securities will outperform their US equity counterparts. Now, the real question becomes, how should we use this information? For younger investors, simply use it to set reasonable expectations. I would not make any portfolio adjustments from this or any other videos. Your portfolio design should be based on your risk tolerance, your time horizon, and your own personal goals. However, for older investors getting closer to retirement, or for those of us that have already reached most of our financial goals, I would consider using this information to structure my portfolio in a more conservative manner. There is nothing that is giving me any indication that for the decade ending in 2035, equities are going to outperform their fixed income counterparts, even though it did happen significantly last year. With that being said, happy investing. Happy New Year to everyone watching this video. Please, if you enjoyed this video, support the channel by subscribing. And as always, when it comes to our money, it is always better to be educated than angry.